money began as measurement. Around 3000 BCE in Sumer, silver was used as a unit of account. Weights were standardized. Transactions were recorded on clay tablets. Temples and palaces acted as financial centers. Deposits, loans, wages, and interest were documented. This is the earliest known financial record system. By 2400 BCE, compound interest was already in use. Contracts specified repayment schedules. Collateral included land, labor, and future harvests. Default penalties were defined by law. In Babylon, around 1800 BCE, the Code of Hammurabi formalized finance. Interest rate ceilings were set. Debt contracts were legally enforceable. Banking moved from custom to statute. In ancient Egypt, centralized administration controlled wealth. Grain was the primary store of value. State granaries issued receipts. These receipts circulated as payment. Taxation, wages, and trade were managed through recorded accounts. In Phoenicia, maritime trade expanded financial complexity. Long-distance commerce required credit. Merchants financed voyages with shared risk. Profits were divided by contract. Capital moved across the Mediterranean. In classical Greece, banking became private. Money changers evolved into bankers. They accepted deposits, issued loans, and financed trade expeditions. City-states depended on commercial revenue. Financial expertise increased state power. In Athens, public revenues were managed through treasuries. Silver from the Laurium mines funded naval expansion. Economic resources translated directly into military strength. In Rome, finance scaled with empire. Roman bankers operated across provinces. They processed payments, loans, and tax transfers. Roman law standardized contracts. Financial predictability supported imperial administration. Roman publicani financed state projects through tax farming. Capital advanced to the state in exchange for future revenue rights. This system connected private finance with public power. After the fall of Rome, monetary circulation declined in Western Europe. Trade contracted. Coin shortages appeared. Wealth concentrated in land ownership. Financial networks weakened. From the 8th century onward, Islamic economies expanded global finance. Trade routes linked Asia, Africa, and Europe. Merchants used bills of exchange. Credit instruments replaced physical currency. Accounting methods improved accuracy. Profit-sharing partnerships financed commerce. Risk was distributed contractually. Capital mobility increased across regions. By the 12th century, European trade revived. Italian merchant cities dominated finance. Florence specialized in currency exchange. Venice financed maritime trade. Genoa funded state borrowing. Double-entry bookkeeping emerged in the 14th century. Assets and liabilities were recorded systematically. Financial transparency increased. Business scalability improved. The Medici Bank established branches across Europe. It used letters of credit to reduce transport risk. Currency exchange profits funded political influence. Banking families became power brokers. In the 15th century, sovereign borrowing expanded. Monarchs financed wars through loans. Defaults reshaped banking fortunes. Risk assessment became essential. The discovery of the Americas introduced massive silver inflows. Spanish mines increased European money supply. Prices rose across economies. This period became known as the Price Revolution. Financial systems adjusted. Credit expanded. Speculation increased. Capital markets matured. In 1602, the Dutch East India Company formed. It issued permanent shares. Investors traded ownership claims. Dividends were paid from profits. The joint stock corporation became operational reality. The Amsterdam Stock Exchange facilitated daily trading. Market prices reflected expectations. Liquidity increased. Capital allocation accelerated. In 1694, the Bank of England was founded. It issued banknotes backed by government debt. Public borrowing became institutionalized. National credit systems stabilized state finance. paper money circulation expanded. Banks transformed deposits into loans. Fractional reserve banking increased money supply. Credit availability supported commerce. In the 18th century, insurance markets institutionalized risk. Marine insurance protected trade capital. Losses were distributed across underwriters. Predictability replaced uncertainty. The Industrial Revolution transformed finance. Mechanized production required fixed capital. Factories, canals, and railways demanded long-term investment. Joint stock companies multiplied. Investment banks underwrote securities. Capital markets funded infrastructure. Productivity increased. Urban economies expanded. In the 19th century, gold standards linked national currencies. Exchange rates stabilized international trade. Central banks regulated reserves and note issuance. London emerged as the global financial center. Sterling became the dominant reserve currency. International loans financed railways, ports, and governments. In the United States, early banking shaped national development. The first Bank of the United States centralized fiscal operations. Political resistance led to its dissolution. Credit instability followed. The Second Bank of the United States regulated state banks. Its removal preceded financial panics. Historical records link deregulation with volatility. By the late 19th century, financial integration intensified. Telegraphs transmitted prices instantly. Capital moved across borders. Investment horizons shortened. In 1913, the Federal Reserve System was established. It centralized monetary authority. It provided liquidity during crises. Central banking became structural. During World War I, governments financed war through debt. Bond markets expanded. Inflation followed currency issuance. Post-war economies restructured financial systems. In the 1920s, credit expanded rapidly. Stock purchases used leverage. Asset prices rose. In 1929, markets collapsed. Banking failures followed. Economic contractions spread globally. Governments responded with reform. Banking regulation increased. Deposit insurance systems were introduced. Central banks expanded oversight. Throughout recorded history, finance followed consistent patterns. Capital accumulation preceded expansion. Credit accelerated development. Institutions stabilized trust. Empires rose with organized finance. Trade expanded with credit systems. Industry advanced with investment structures. Money moved through law, record, and contract. Wealth followed organization. Power followed capital. This is documented history. This is the financial architecture of civilization.